The balance sheet is a vital financial statement for any business. It provides a crucial snapshot of a company's financial position. Unlike other statements, the balance sheet shows this financial position at a single, specific point in time, not over a period. It fundamentally accounts for a business's assets, its liabilities, and its shareholders' equity, all interconnected within the company. For investors, creditors, and managers, this statement is essential. It offers profound insights into what a company solely owns and owes. The balance sheet structure is built upon one fundamental accounting equation directly stated in financial practices: assets equals liabilities plus shareholder equity. Assets are what a company owns. These resources are expected to provide future economic benefit, enhancing the company's operations and value. One key asset is cash. This includes not just physical currency but also bank balances, which are readily available for company use. Another crucial asset is inventory, the raw materials, work in progress, and finished goods a company holds for sale, driving future revenue. Long-term assets include property, plant, and equipment. These are the physical assets companies use to produce goods or services, like buildings. Liabilities represent what a company owes to external parties. These are its financial obligations, which must be settled in the future. Accounts payable are current liabilities, representing short-term debts for goods or services purchased on credit and not yet paid. Long-term liabilities include bank loans and bonds payable. These represent money borrowed that needs to be repaid over an extended period. Shareholder equity represents the owner's residual claim on assets after deducting liabilities. It's the amount invested by shareholders. Equity typically includes contributed capital from issued shares and retained earnings, accumulated profits not distributed as dividends. Now, the accounting equation becomes clearer. The total value of what a company owns, assets, exactly equals what it owes plus ownership claims. Analyzing the balance sheet helps investors assess financial health. It offers insights into stability, liquidity, and risk exposure. Millionaire investors look for strong assets. A healthy balance sheet shows ample resources that can generate future revenue or be readily converted to cash. They also scrutinize liabilities. Manageable debt levels, meaning the company can comfortably meet its obligations, are crucial for long-term viability. A solid equity base is equally important. It indicates a substantial ownership stake, providing a buffer against financial downturns and showing investor confidence. Balance sheet analysis empowers investors to make strategic decisions. It helps identify financial trends, manage risk, and informs investment choices. Experienced investors look for trends: consistent growth in assets and equity, combined with stable or decreasing liabilities, signals strength and opportunity. To deepen analysis, millionaire investors often use financial ratios derived from the balance sheet. These ratios provide standardized insights. The current ratio, current assets, current liabilities, indicates a company's ability to cover its short-term obligations using easily convertible assets, signaling liquidity. The debt-to-equity ratio, total liabilities shareholder equity, reveals how much debt a company uses to finance its assets versus shareholders' funds, indicating risk. Millionaire investors generally seek low debt-to-equity ratios and healthy current ratios. These metrics typically highlight financially stable companies with less risk. Beyond just the numbers, smart investors also consider industry context. What is normal for a tech startup may differ vastly from a utility company. Millionaire investors also evaluate management. A strong management team is adept at utilizing assets efficiently and managing liabilities responsibly. Some investors prioritize growth, accepting higher risk, while others seek stability, preferring low debt. Your investment strategy guides your interpretation. Start by regularly reviewing balance sheets from companies you're interested in. Look for the specific components and ratios discussed previously. Like any skill, reading a balance sheet improves with practice. The more you analyze, the better you become at identifying strong investment opportunities. Mastering the balance sheet empowers you to make informed investment decisions today. Subscribe for more financial insights and join our investing community.